All right, welcome back, guys. Today I'm going to be doing COMM 305, Chapter 2, Managerial Cost Concepts and Cost Behavior Analysis. So first, looking at the legend, so anything already highlighted in yellow, like this, is our section title. Anything in blue, like this, is our heading. Anything in green is our subheading. So let's look at the main points. So one, define three classes of manufacturing costs. So manufacturing costs, differentiate product costs and period costs. So what's the difference between product costs and period costs? Two, explain variable. I'll highlight that in blue. Variable, fixed, mixed, and relevant range. Three, high-low method for mixed costs. And then four, calculate cost of goods. Prepare financial statements for manufacturers. So financial statements for manufacturers. And five, regression analysis for mixed costs. All right, so let's start with number one. One, managerial cost concepts. So managers should ask, what cost is involved to make or provide a product or service? So the cost for a product or a service. So will cost decrease if the production volume decreases? That's another question they may ask. What is the impact of automation on cost? So, well, if we try to implement automation, will it increase our cost or decrease our cost? How can we control cost? And this is an important question as well. So, cost is an economic resource given up to accomplish a particular objective. So, cost object, it's anything we want to calculate a cost from. So, an example is a product line, a service, or a process. So, manufacturing costs. So, manufacturing consists of activities and processes that convert raw materials into finished goods. So, we're converting raw material into finished goods. Raw materials are pretty much just basic materials from which a product is made. Raw materials can include aluminum for a phone frame. I'll put that in yellow as well. So aluminum, glass for a phone display, lithium ion for a phone battery, plastic for a phone button. There's a lot of other raw materials. These are just 4 examples of. So manufacturing costs are incurred at the production facility. So make sure you remember that. And incurred is the recognition of an expense. And I'll just highlight this part. So manufacturing is in the production facility. So if it says something about how this manufacturing was talking about in taking place in the headquarters of let's say a company, it wouldn't really count as an expense towards our manufacturing costs because it's not part of the production facility. It's not in the actual facility where the finished good is being produced. So an example of this is direct materials, direct labor, and overhead, manufacturing overhead, which I'll explain later. So merchandising, it sells goods in the same form in which they are purchased. So direct materials. Direct material is raw material physically and directly associated with the finished product during manufacturing process. So what, like I explained before, it's directly associated with the finished good in the manufacturing process. And examples of this is the flour in the baking of bread, syrup in the bottling of soft drinks, steel in the making of automobiles. So raw materials as well. So indirect materials are raw materials, I'll put this in pink, that do not physically become part of the finished product or cannot be traced because they are insignificant. So examples of this is lubricants, polishing compounds, sandpaper, and glue. And then indirect materials are part of the manufacturing overhead. And as well as these, let's say for a bigger example is if we include glue, let's say in our phones to keep the glass connected to our frame, we would consider this an indirect material because the glue isn't really calculated and its size and impact on the phone is so insignificant that we don't even calculate it as a direct material. So direct labor, Direct labor is the factory employees physically and directly associated with the use of raw materials in the finished goods. So factory employees directly associated with the use of raw materials in the finished goods. So what you could see in the pattern is through direct labor, indirect materials, and direct materials, we're always talking about raw materials. So an example of this is assembly line worker, machine operators, construction workers, chefs, and cooks in a restaurant. So direct labor cost is decreasing due to automation, and that's just something to be aware of in the future. So indirect labor has no physical association with the finished product, or that the work is impossible to trace cost to. So an example of this is wages of the maintenance people, timekeepers, and supervisors. Indirect labor is classified as manufacturing overhead. So this is indirect labor is similar to indirect materials, which we classify them as manufacturing overhead. So what is manufacturing overhead? Manufacturing overhead is costs that are indirectly associated with the manufacturing of the finished product. Factory overhead, indirect manufacturing costs, and burden also mean manufacturing overhead. So all of this, I'll highlight that, are just different ways of saying manufacturing overhead. Manufacturing overhead includes indirect materials, like I explained before, indirect labor, like I just explained, depreciation on factory buildings, depreciation on factory machines, insurance, property taxes, and then maintenance on factory facilities. So these 5 is good to remember, as it is something that may come up in examples or questions. So prime costs and conversion costs. So prime costs are the sum of all direct material costs and direct labor costs. So I'll put that in blue. The sum of the direct material costs and direct labor costs. This has to do with direct manufacturing costs. So prime cost is equal, and this is just, if you guys like to look at it through a formula, it's just direct materials plus direct labor. So conversion costs, I'll put this in green. This is the sum of all direct labor costs and manufacturing overhead costs. So this is the cost of converting raw materials into a final product. And just like the other one, if you guys like to look at it in a formula-based, conversion cost is equal to direct labor plus manufacturing overhead. And this right here underneath is a diagram to show you guys the difference between prime cost and conversion cost. So you have direct labor, and if you add that with direct materials, this gives you your prime costs. If you do direct labor and manufacturing overhead, this gives you your conversion costs. So product versus period costs. Product cost is cost necessary for the production of the finished product / inventoriable costs. Costs necessary for the production of the final product. All manufacturing costs are product costs. So product costs are recorded as assets. So we're going to record them as assets, and then they become an expense when the company sells the inventory. So eventually becomes an expense when we sell the inventory, and then record expenses as cost of goods sold. So guys, make sure you remember that and don't get confused as initially putting your product cost as an expense right away. This isn't a good thing to do. So period cost, this is the cost associated with the revenue of a particular time period. These are non-manufacturing costs. So an example of this is selling expenses, administrative expenses. Period costs are deducted from revenues in the period in which they are incurred. So you could see here, just a diagram summarizing everything we just saw. So product costs has anything to do with the manufacturing of the final product. So direct materials, direct labor, manufacturing overhead, which we explained before. Then we have period costs. These are non-manufacturing costs. So like selling expenses isn't like I said, it's not part of the manufacturing. Selling expenses, which is where we sell the final product. This doesn't happen in the facility or the manufacturing of the final product. This is after it's manufactured. So this is a non-manufacturing cost. And an administrative expense is the exact same example. It's not part or doesn't take place in the facility in which the final product is made or manufactured. So 2, cost behavior analysis. Cost behavior analysis is the study of how specific costs respond to changes in the level of business activity. So let me highlight that in orange. Specific respond to the changes in the level of business activity. So cost behavior analysis is measuring key business activities. Some costs change when activities change. So an example of this is for airplanes, the longer the flight, the higher the fuel costs. So the costs change as the activities change. And the activities can be literally anything. So for an airplane, it could be flight time, it could be waiting time. So sometimes you have to clean off a plane when it's in the winter, and just something like that. So some costs remain the same. So I'll put that in yellow since it's opposite of the orange. So costs remain the same. An example of this is like, let's talk about hospitals. Costs to run emergency rooms are usually constant, no matter if we have a patient or not, because for lights, it's always the same amount of money to keep the lights on. So activity index, this identifies the activity that causes changes in costs. So we can classify the behavior of costs in response to activities in 3 categories. We have 1, variable. So variable, which I'll explain right here. 2, fixed, which I'll explain right after. And then 3, mixed. So variable costs. Variable cost is costs that vary in total directly and proportionally to changes in activities. So I'll put that in blue. So it changes proportionally to changes in activities. So an example of this, if the level of activity increases by 10%, total variable cost increases by 10. As you could see, they both change proportionally. If level of activity decreases by 15, then our total variable cost decreases by 15. And this is the diagram. You guys could see and pause it if you want. And it just shows how it looks like for a total variable cost. All right, so for fixed costs are costs that remain the same or slash fixed in total within the relevant range, regardless of activity changes. So an example of this is property taxes, insurance, rent, supervisory salaries, depreciation on buildings and equipment. So regardless of our activity changes, our depreciation on our buildings and equipment will always be the same throughout the years. Our rent for a whole year should be the same, and depending on if we use it or not, rent will always equal the same. Fixed costs per unit vary inversely with activities. So an example of this is volume produced increased. If we increase our volume, our unit cost decreases, and then if our volume produced decreases, our unit cost increases. So let me highlight that in green. So if there's an increase, our unit cost will have a decrease. If our volume produced decreases, our unit cost increases. And this is pretty much, I think it's from econ, where it's economies of scope. So the higher you produce, the less it will actually be for you in total, or per unit, I should say, sorry. And then the less you produce, the higher it is per unit. And this is just showing, so total fixed cost, as you can see, it's always constant. So if I produce 2, 4, 6, 8, 10,000 tablets, it's all going to cost 10,000. So let's say here it's per unit. So if we're producing 2,000, it's going to cost $5 per unit. 4 tablets, it's going to cost $2. 6, it's going to cost 2.5 around. 8, around 1. So manufacturers have more fixed costs and fewer variable costs due to automation. So like I explained before, automation, this can be because of depreciation and rent increases, which is a fixed cost. So depreciation and rent is fixed, and then direct labor cost decreases, so variable. I'll put that in orange again. So with automation, just to highlight this part, you have more fixed costs and fewer variable costs. So relevant range. Relevant range is the assumption that cost is linear or in a straight line. So cost is linear. So an example of this is if the activity level doubles, the cost also doubles. So note, relevant range in most business situations is difficult and hard to achieve because it's not really realistic. So curvilinear is more of a real world relationship between variable cost and changes in activity level. So it's more of a real world relationship. Total fixed cost nonlinear occurs when cost increases to a new fixed amount when activity levels change. So you guys can see the difference between curvilinear, and then nonlinear, nonlinear total fixed cost. So you could see here it's more of a curve that you have as the activity levels goes up. And you could see on nonlinear over here, once the activity reaches a specific amount, so let's say I think this is around 30, we'll say. So once our activity level reaches 30%, our cost jumps straight to whatever this point would be. And the same thing could be said with 90. So once our activity level reaches 90%, it automatically goes to the next fixed cost. And that's why it's called total fixed cost, but it's non-linear. Since it's not a straight line, it's more just bars. So that's good to remember, and make sure you guys understand this diagram for both. So relevant range. So range a company expects to operate in during the year. So it's the range expects to operate during a year. So you can see using the same diagram as we saw before, our relevant range is this. So from 40 to 80, this is what the company expects to operate in during the year. We expect to hit a low of 40% in our activity levels and a high of 80% in our activity levels. And we expect it to be in between those two. The same thing for our total fixed costs. Our relevant range will be from 40 to 80 and anything in between. All right, so mixed cost. Mixed cost is costs that have a mix. So self-explanatory, mix of a variable cost and a fixed cost. An example of this is each month the electricity bill includes a flat service charge. So this is fixed, and a usage charge, so variable. So let's say if we let's say if we rented out a cottage, we never use the electricity, our flat service charge will be charged, and our usage charge, which is our variable charge, won't be charged since we didn't even use it. So this is always fixed. So no matter what, even if we don't use it, we're still going to be charged that. All right, so 3, the high-low method of classifying costs. For cost behavior analysis, mixed costs must be classified into fixed and variable components. So I'm gonna highlight that. Each time a mixed cost is incurred, determine the variable and fixed components, or collect data on the behavior of the mixed costs at different levels of activities and identify fixed and variable components. All right, so here this is our high-low method. And our high-low method is to figure out and classify fixed and variable components. So high-low method is a method to separate mixed costs into variable and fixed components. That's what I just said. So variable and fixed components. So variable cost is found through the difference between the high and lows of activity levels. So I'll put that in purples because it's the difference between high and low activity levels. And note, only variable costs can change as activity levels change because our fixed cost has nothing to do with activity levels changing. So even if we use it, even if we don't use it, if we use half of it, our fixed costs will never change according to that. So here are the steps in calculating fixed and variable costs. So step 1, determine variable cost per unit using the formula below. This will give the slope of the cost function. So I'll put that in orange. So determine the variable cost per unit. And this is the formula: change in total cost at high versus low activity divided by the change in activity and total activity at high versus low activity levels. And this will give us the variable cost per unit. So here we have our first example, which I'll do with you guys. So we have our metro transit company. So we have we're given a diagram with the months, kilometers, and total costs. So our months are January, February, March, and April. And so what we want to do is step one, write our knowns. And this is the high and low levels of the kilometers driven. So what we can do is now since we know we want to find the high and lows of the kilometers driven, we want to look at the columns with kilometers driven. So these are the two columns. And then we just look at it. So we have 40,000, 80,000, 70,000, and 100,000. So what is the high of this activity? So we could see that the high is 100,000 in April. All right, so then for the low of activity, we do the exact same thing. So look at the two columns, but we just find the low of them. So now we have 40,000, 80,000, and 70,000. So which one's the lowest? It's going to be 40,000 in January. All right, so now we want to find, step two is find the difference in the kilometers. So we have 100,000 minus 40,000, which gives us 60,000 kilometers. Step three, we want to find the maintenance costs of these two levels. So the maintenance cost in April is going to be, and our maintenance cost is total cost. So we're going to look at these two columns. And so look at the column that has April in it. April is right here. So it's going to be 63,000. And then we're going to have maintenance cost in January. It's the same thing. So find January and then find the column with total costs. That's going to be 30,000. And I'll find the difference in maintenance costs. So we're doing the exact same thing as we did with our kilometers, but now with the maintenance cost. So 63 minus 30,000 is equal to $33,000 in our total costs. So step five, we want to figure out so the answer. So what we have here is 33,000 divided by 60,000. This is equal to $0.55 per kilometer. If you guys are wondering why I put the 33,000 before the 60,000, is because when we figure out the price, we say price per kilometer, and it's not kilometer per price. So if we say price per kilometer, that means we do price first, then kilometer second. And so that is our variable cost. I'll put it right next to it, variable cost per unit. So step two, determine fixed cost by subtracting total variable cost from the total cost from the high or low activity. So you guys can see I already did it here. So example for the Metro Transit Company. So find our knowns, our total variable costs. Our total variable cost is equal to variable cost per unit times the amount of units. So our 0.55 is, put that in yellow, is the one from here. And then 100,000, put in blue, is from right here. And this gives us 55,000. And so I'm just going to repeat that. So the low of activity, so that means taking, for our kilometers, it's taking the lowest amount. So our lowest amount was in January, like we said. So 0.55 is like right here. And then 40,000 is the one in January. And then that gives you 22,000. And so usually you guys would either do one or the other. I'm showing you guys both just to show you that both work and both are going to give you the exact same answer. So from this, we want to subtract total variable cost from total cost. So this is our total variable cost, if that was not clear before. So what we do here is we take our 55,000 and then we take the 63,000, which is all the way up here, and we subtract it, and that gives us 8,000. And then we have 30,000, which is all the way up here, or where we got it from, minus our 22,000. And that gives us 8,000. So it's the exact same thing. So our fixed cost is always going to be 8,000. And just one thing that you guys should be aware of mistakes is if you either pick, so usually, let's say we wouldn't do this. So we would only take the high activity. So whenever we're looking at the numbers, make sure that you guys label them correctly. So if I'm doing the high activity like this, I'm looking here and trying to find only the high activities, because I've seen some people make mistakes where they confuse the high activities with low activities and they combine those numbers, and that gives them the wrong answers. I'll just delete that. And so, yeah. And so if you guys really want to make sure, if you guys do both of them, they should give you the exact same number. And that's just like a trick so you make sure that you got the right number. So step 3, calculate total maintenance cost. So total maintenance cost is equal to the fixed cost plus variable cost. So fixed cost we just saw like right here. So what that is going to be 8,000. So the 8,000, just to make it really clear for you guys, is right here. And the 0.55 is our variable cost, is what we calculated right here. So per unit. And that's pretty much it. So that's our total maintenance cost. And you guys can see that the diagram below shows us the results. So if we grab our calculator and if we just want to make sure, so we do 0.55 times, let's say the kilometers driven, we're going to do 40,000. So 0.55 times 40,000 plus 8,000 gives us 30,000. And that's going to be this exact same thing if we plug in 100 kilometers, 80,000, 60,000, or 20,000, or anything in between. So this is the right answer. So if two data points are representing the entire data set, the high-low method provides reasonable results. If the high and low data points are not representative, put that in pink, of the rest of the data set, then the results are misleading. So 4, manufacturing costs in financial statements. So the difference between manufacturer and merchandiser financial statements are, well, the current assets section of the balance sheet. So I'll put that in purple. The cost of goods sold section in the income statement. So both merchandiser and manufacturer follow the same steps in the accounting cycle. And this is shown from COMM 217, if you guys remember it. So we have the steps, just to refresh. 1, originating data, journalizing, posting to the ledger, creating your worksheets, financial statements, adjusting at the end, and then closing. And then posting the closing. So now this brings us to the balance sheet. So the balance sheet helps managers determine sufficient inventory exists for demand. For a merchandising company, the balance sheet shows one category of inventory. For a manufacturing company, the balance sheet shows 3 inventory accounts. So that's what we want to take into account. We have 3 inventory accounts. We have raw materials, work in process, and then finished goods. Manufacturing inventories are listed in order of liquidity, which is the expected to be realized in cash. So our first thing listed in an inventory is finished goods. Second would be work in process. And then third would be raw materials. So this is an example right here. And you guys can see in red the inventory, and the liquidity. So like I said before, finished goods is first because it's an order of liquidity. Work in process is second, and raw materials is third. So income statement. Income statements differ from merchandiser and manufacturing on the cost of goods sold section. So cost of goods sold, this is calculating it. So merchandiser calculates cost of goods sold with beginning merchandising inventory plus cost of goods purchased minus ending merchandise inventory. For manufacturers, they calculate cost of goods sold by beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory. And just so if that wasn't clear, this is a picture so you guys can see, and it's the exact same thing. It just summarizes all the formulas for a merchandiser and a manufacturer. So you have your beginning merchandise inventory for both, or beginning finished goods inventory, and cost of goods purchased, cost of goods manufactured, and an ending merchandise inventory, ending finished good inventory. And these are both for the cost of goods sold for the respective type of company. So cost of goods sold presentation. So merchandising company, this is how they present it. They have a merchandising inventory such as this, and it's under the cost of goods available for sale. For manufacturing company, it's the exact same thing, but they have a finished goods inventory. So comparing merchandise inventory and finished goods inventory. So determining the cost of goods manufactured. So let's take an example of the graphics card company. The beginning work in process inventory is partially completed graphics cards. This is the cost based on manufacturing costs incurred in the prior period. Manufacturing costs incurred in the prior period are expenses associated with the production of goods or services in a previous accounting period. So let me highlight the previous accounting period, because since this is prior period, we want to look at what we ended the year before with, our prior period. So our formula is here, total manufacturing cost. We have direct material cost plus direct labor cost plus manufacturing overhead cost. And hopefully you guys are, if you guys don't remember what this is clearly, make sure you just go back in the video, you remember it, because in the exam or examples, they won't exactly tell you which one is direct, which one's direct labor, and which ones are manufacturing overhead costs. So that's why it's really important to understand what these three are and how to figure those out. So total cost of work in process in the current period is equal to the cost of beginning work in process plus your total manufacturing cost. Your ending work in process inventory is the end of year graphics cards that are partially completed. So sometimes throughout a year, we're continuously creating graphics card, let's say for this example, and we're not going to stop since it's the end of the year. We're going to keep on going. But let's say a graphics card takes 1 month to complete. If we begin it in the middle of January, December, the graphics card is only going to be done by January, in the middle of January. So this means it would be a work in process inventory. So the cost of goods manufactured is equal to the total cost of work in process minus the cost of ending work in process. So here's just another picture for your cost of goods manufactured. So we have our beginning work in process inventory plus our total manufacturing cost. This will give you your total cost of work in process inventory. Then we use this. So we use it here. That's why the red arrow. And then we use that minus ending work in process inventory, which gives us our cost of goods manufactured. So we can see here, cost of goods manufactured, the schedule. So this the reports cost element used in calculating cost of goods manufactured also details data for direct materials and for manufacturing overhead. So you can see here is our cost of goods manufactured schedule, just in case that wasn't clear. So we have our direct materials, we have our direct labor, and we have our manufacturing overhead. And we also have our total manufacturing costs and everything like that. And at the end, we have our cost of goods manufactured. So note, total manufacturing cost for the current year does not include beginning work in process inventory. So that's just something you guys should keep in mind when you guys are calculating total manufacturing costs for the current year. So total manufacturing cost is equal to direct material cost plus direct labor cost plus manufacturing overhead cost. Cost of goods manufactured is beginning work in process plus total manufacturing cost plus minus, ending work in process. And I believe I wrote that up here. Yeah, so I wrote that again just so you guys will see. I will do later examples using these formulas so it's better explained for you guys. So lastly, number 5, regression analysis. So regression analysis is used when the high-low method does not provide a good representation of the actual relationship of our data. So the regression analysis is a statistical approach that estimates the cost formula using all data points. So compared to the high and low method where we use the high value and the low value, here we're going to be using all data points. So regression analysis finds a cost formula that minimizes the sum of the square distances from the line to the data points. So this is just a summary of what it does. Since we're using Excel, so you can see my note, this class uses Excel. You guys won't need to know the sum of square distances. That's from 215 or another course that you did, but we'll be using Excel and that I'll show you guys how that works. So note, regression can be influenced by outliers, so data points that differ significantly. This is just a note for you guys to know that if we have an outlier, this can affect the regression analysis. And if you ever get that in a true or false or a multiple choice question. So regression estimation is most accurate the more number of data points you have. So let's say if we only have 10 data points, it may be a good amount, but if we have, let's say, 100, it's even more accurate than 10 since it includes more numbers and it has more variables for considering outliers. So I'll show you guys an example right now. All right, so we have our table here for the regression analysis. So I'm just going to show you guys how to create a table and how to show the graph, show the trend line and everything. So first you want to do is just, let's say, get a table. So like this, you want to select everything. You guys can include the X and the Y or your headers if you want. I'll include and see what that gives us. So then you want to go to insert on the top over here. You want to go to the charts and we're going to want to do a scatter. So it's going to be the first one. If you hover over it, it'll pop up the name of the actual table. So when we click on it, it says scatter. It brings this up. We can change our header. So we'll just write regression table or chart. Doesn't really matter. And so if you, let's say we don't have this, if you guys want to bring up our trend line, so we click on the plus right here. We want to check mark the trend line. That gives us the little dots. If we click the plus right next to the trend line, we can go here and click on more options. This will bring up our format trend line on the right side. And on the bottom, so on the complete bottom, we have display equation on chart, display r squared value on chart. So we're not going to need the r squared, but we want the equation. So this is actually our equation for our regression. And so you can see is we have our x and our y. So if we plug in, let's say our x, so let's try to do that. So 2.0586. Let's say our x is going to be 10 plus 0.0842. It's not a typo. Oh yeah, sure. So it gives us 20.67. You could see if we go and check over here, it's 21. So we round it up. You can see the actual one is 20.67. So guys, that's pretty much how to create your regression chart. All right, guys, so we're going to start with some examples now. And I just included this section, chapter 2 formulas. Since we'll be needing some of the formulas, these should be all the formulas given throughout the chapter. So you guys can take a picture, pause the video and take a picture if you guys would like for the future. And now I'm going to start with some examples. So here, our first example is the Bonita company. We want to figure out how much is the total manufacturing cost. So we're giving everything our direct materials. We're giving all of this, direct labor, total manufacturing overhead, ending work in process, cost of goods manufactured. So what I like to do is to do this in steps. So step one, write our knowns. So sometimes in a question, we may be given a lot of things. Let's say for this question, we're giving 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 things with numbers. So sometimes it can get overwhelming or confusing. So using with steps is a way to condense it and to make everything more clear. So what do we want to figure out? That's the first thing I like to write down. So total manufacturing cost. And our formula is right here. So direct material cost. So I'll just copy paste that. And let me increase the size so it all fits. Perfect. So now we want to figure out our material cost, our direct material cost. Let me highlight that. So this is equal to, so looking at this, what do you guys think would be the direct material cost? So you could see here we have the direct materials, we have all of this. And then direct materials used are 30,000. So that's what we're going to want to use. 30,000. Direct labor cost. So once again, once we look at the Bonita company cost of goods manufactured, we can look direct labor is 6,200. 6,200. And then we have our manufacturing overhead. And now if we look again, we could see total manufacturing overhead is 10,900. So let's write down our knowns. Now this brings us to step 2, which is to calculate now. So now we have the 3 knowns to calculate our total manufacturing cost. So we can do that right now. Let me write that out. So let's replace it. So direct material cost is equal to 30,000. Direct labor cost is equal to 6,200. And manufacturing overhead cost is equal to 10,900. And if you do an equal sign, 47,100. So that's how much our manufacturing cost is. All right, so this brings up to the second example. So we have the Federal Corporation incur the following costs while manufacturing its products. We have the materials used in product, depreciation on plant, property taxes on warehouse, labor cost of assembly line workers, factory supplies used, advertising expense, property taxes on plant, delivery expense, sales commissions, salaries paid to sales clerks. So work in process inventory was 10,200 at January 1st, 14,000 at December 31st. Finished goods inventory was 60,000 on January 1st and 51,000 at December 31st. For part A, we want to calculate the cost of goods manufactured. So like I did with the first example, we want to put this in steps. So step 1, write our knowns. So we know that we want to calculate the cost of goods manufactured. And we can find the formula from our formula sheet, cost of goods manufactured. We see that it's equal to, I'll just get rid of that part. So our cost of goods manufactured is equal to the beginning work in process plus total manufacturing cost minus ending work in process. So is there anything else we know in this formula that we could write down? So we do know our beginning work in process. Let me have that. So this is equal to 10,200 since it says work in process inventory was 10,200 at January 1st. January 1st, we assume is our beginning beginning of the year and our beginning work in process. 10,200. So our ending work in process is going to be 14,000 since at December 31st, this is our ending work in process. 14,000. So the only thing we don't know is our total manufacturing cost. And we're going to put a thing here so we know we have to calculate it. So step 2, we want to calculate total manufacturing cost. So total manufacturing cost is equal to, so let's find our formula from up here again. Total manufacturing cost. You can see it's direct material cost plus direct labor cost plus manufacturing overhead cost, like our first example. So now we're going to want to find our direct material cost. So looking at the list here, which one's a direct material cost? And there's only one. It's going to be materials used in product, which is the first one in the list. It's going to be 100, 121. All right, so that's our direct material cost. Then we have direct labor cost. So which out of here is our direct labor cost? And we could see it's the labor cost of assembly line workers. Labor costs, assembly line workers. This is equal to 110,900. And now we have to find our manufacturing overhead cost. And we can see here, there's going to be 3 in our list. So if you guys want to try to find out what that is, you can pause it right now, look at it for yourself. So the first one is going to be depreciation on plant. Let me write that properly. Depreciation is 63,400. Next, we're going to find our factory supplies used, which is equal to 25,500. And then last, we have our property taxes on the plant, which is equal to 19,500. And now we just want to sum everything together. So total train cost is equal to 121 plus 10,900 plus 63. I'll put this in a bracket so you guys know that this is going to be manufacturing. 25,500 plus 19,500, which is equal to 340,300. And so we can replace this now with, I'll put this as an arrow, 3,400, 300. So now we can do our step 3, which is the total. Our cost of goods factored. This is equal to 10,200, which is our beginning work in process, plus our total manufacturing cost, which is 340,300, minus our ending work in process, which is 14,000, which gives us 336,500. I'll put that in orange, and this is the right answer for part A. All right, so for part B, calculate the cost of goods sold. So step 1, like all the other examples, let's write our knowns. Let's find our formula for the cost of goods sold. And if you look here, you'll see 2 different types of cost of goods sold. Since we're working with inventory, we'll want to take this one. There's another example where we would take cost of goods sold, and that's when we're dealing with our units. So the units sold. So let me just paste that. Make this bigger so everything fits. Perfect. So the beginning finished goods inventory. So we could find this at the bottom of our text. So you can see here, finished goods inventory was 60,600 at January 1st. So let's write that down. 60,600. And then we can find our ending merchandise inventory, which is equal to, it's here, finished goods, ending is the 51,300. Let's write that down. 300. And we also just calculated our cost of goods manufactured in our second example. So we could just write that down right away. So now step 2 is to calculate our total. So 60,000, or sorry, I'll write cost of goods sold, inventory, to 60,600 plus 336,500. I believe it's a minus. Yeah, minus 51,300. That gives us 345,800, and that should be the right answer. All right. Thank you guys. If you guys have any questions, just leave a question down in the comments. I'll make sure to answer that. So thank you.